Welcome to another episode of Dividend Talk. Today, we have Dividend Dane as our special guest, and we will have a conversation about real estate investment trust and all what's going on right now. Oh, and in case you are wondering, Engineer My Freedom is getting drunk this weekend. I think he deserves it after 66 shows being in a bromance with me. But I'm really happy that Dividend Dane has been willing to join us today. So, having said that, see you all in the inside. Hey, Dividend Dane, welcome back to the show. How have you been?
I've been fine, European DI. Hope you're doing well.
Definitely. It's been a busy week for me. I heard you also a bit talking about your work. So I hope, how you said, we can have some more fun now talking about dividend stocks and dividend investing. So
Exactly.
um, people that don't know you yet, we call you Mr. Real Estate Investment Trust because we all know that you have a strong passion for this. So I'm really glad that we can also talk a bit more about real estate investment trust here. I can definitely say that EMF and myself are not the strongest on this topic because we are deep with our heads into consumer staples. So I'm really looking forward for this. Well, having said that, I think people know you from earlier shows. So why don't we just go straight away to the news on the news of the week? Is there anything that has caught your attention this week?
Yeah, I mean, for me, the most important news of the week is energy prices going through the roof everywhere. Not just in England, that have run out of gas quite recently. But everything is like coal is record highs. We have oil back at 2016 levels, everything, gas prices. So it's going to be not only a cold winter, but an expensive one for everyone here in Europe. So,
Yeah, I'm really how you said impressed by what's happening regarding this right now in the world. I mean, I remember last year when I was deep in oil and I'm still having a lot of energy. I got bashed a lot on the social media for being so sticking to oil and actually bullish on oil. I mean, of course, it's easy to say now because now prices are high. They can easily be in few months again half of this. But this is the boom and bust cycle of what we know about oil and gas, and that's why it's usually not clever to buy to sell it at the bottom and to buy it at this because the yields are how I said the PEs are always inverted. Right now, PEs are low, and it's actually a time you shouldn't probably buy them anymore. While when the PEs are highs, are the time to buy for this. And um, I mean, there's so much crazy stuff going on in the world right now. I mean, we have the whole supply chain issue that we have. We have just like there's been such a large underinvestment in oil and gas assets over the last 5 years because what we are facing now is not a response from last year. We are now facing the pain we are taking from the underinvestment since 2016 by all the big oil and gas companies slashing their capex, their investments. That's what we're suffering now from.
yeah, exactly. Yeah. And I heard that not only is right now some of the OPEC countries are actually in the middle of doing a lot of work on their oil fields, so they can't just ramp up production so demand will outpace supply for quite a while. And
Yeah.
yeah, so it's the opposite of like you mentioned, you bought Rio Tinto at a like iron ore prices has been cut in half
Yeah.
in a short time, and the reverse happened to oil. So
Yeah.
interesting times we live in.
And it's really crazy right now, and with all of this, so it just tells us again how important it is to have a portfolio that is a bit diversified across sectors. Because, for instance, the stock markets have been going down in September, but my portfolio was going up because of my position in oil and gas. Yeah, and this continuously it's going like this. So it's really important for us as investors to figure out on what sectors are we most bullish and build your positions accordingly, but stay diversified because it might just help you out in difficult times.
Exactly.
Well, we'll see where this goes. The winter is coming up in Europe. Gas prices, might create an issue to households. So inflation will come back. It will also be interesting to see what the ECB will do. And by the way, I even read that France is going to cap the prices of gas. They're not going to allow price increases. So also governments are stepping in at the moment here.
Yeah, but they have an election coming up in France as well. I mean, so if people are freezing to death in in their houses, I mean that's probably not going to do well for any chances of Macron being reelected, I would imagine. He has an interest in making sure things don't go crazy down there.
Well, from the other side, he gets them outside to go for a walk to the voting machine.
Always look on the bright side here.
Exactly, exactly. And we just had Germany, Germany, new elections. I mean,
Yeah,
yeah. Good. Hey, so that's all about energy. It will be really interesting to see this in the upcoming weeks. I think the story is definitely not done yet, and we'll see some crazy stuff. That's my expectation here.
I would imagine so.
So having said that, let's go a bit to the main topic of this week and have a conversation about real estate investment trust. And maybe as a recap, because we had you on a show earlier a little bit, can you for newer investors that are following our podcast, can you explain maybe in few words what is a real estate investment trust?
Yeah. So the a real estate investment trust is a kind of a company form that or type of company that originated in the United States and then since been adapted across the world. Essentially, the point of it is that the real estate investment trust doesn't pay corporate taxes, but with that comes the responsibility that they have to pay out a very large percentage of what they earn through dividends. And that is why it is very attractive to dividend investors or dividend growth investors, because of that reason. You can be pretty sure that you're going to get a good dividend from those companies. Having said that, that is also where the taxation then happens. And so the government has an interest in having these companies.
Yeah, and that's, I guess, also why it's called a trust, right? Exactly for that reason.
Exactly.
And how do the American real estate investment trust differ from Europe? Because I think in Europe we often don't even call them an investment trust, right?
Yeah, we have to some degree adapted the form of the real estate investment trust, but as always, Europe is not unified in how we do business. So there are differences from Britain to Germany, and not all countries have real estate investment trusts in Europe, but we always want each and every country want to meddle a little with the rules and regulations. So the overall framework is still somewhat the same, but there are local regulations to how much capital they must hold and how much of their income or earnings must come from real estate related uh, activities. And there are some rules in Germany about having if you have like the maintenance of the building or the managing part of the building, how that you have to restructure that in a different company. And so there's a lot of different rules and regulations, and that's why if you are a European investor, make sure you know what rules uh, govern each and every country that you want to buy in, instead of just thinking, oh, it's all the same as it is in the US, because
Yeah.
it's not. And there can
Uh,
be also a couple of some accounting differences that are different from each and every country. So just something
Yeah.
to be aware of.
No, and from a European Union point of view, I will never think we will see any consolidation there in the regulation, because if we can't even agree on the size and the how you say it, the width of a cucumber,
Exactly.
then and that's one of the more simple things than a real estate investment trust concept.
Exactly.
So, and then there was a question actually from one of our followers from Thiago, and he asked like more around how do we evaluate a real estate investment trust? And he started to ask about the price to earnings metrics and
Yeah.
why do they typically look different between US and EU? You know, there's something specific about this, right? Could you elaborate a little bit more on
Yeah.
that?
Um, I actually spoke to Tiago slightly just to make him clarify which sectors he was looking at. And he mentioned, like, for instance, a company that's been mentioned on Dividend Talk a lot of times, the German Vonovia. And he then compared it to an American company called Essex Property Trust, because they are essentially, they do the same kind of thing. Vonovia has a lot of apartments in Germany. Essex Property Trust has a lot of apartments in the western part of the US. And so what I would say, and I'm not a fan of using the PE metric because it distorts the reality of the earnings. So, for instance, Vonovia trades at a PE of 7, which is of course very low. And if you look at the Essex Property Trust, you get a trailing PE of 51. So that's of course there's a big difference. But if you use the metric you would normally use, which is the price against the funds from operations, you get a more normal 25 metric. So that's one thing. But what I would say is that Vonovia has a lot of political risk. There's been a lot of talk in Germany with regards to the election of a referendum where essentially they wanted, a part of the left wanted to essentially expropriate, that is the government taking over all of the apartments Vonovia own, um, which is, of course, a massive political risk. Uh, I don't personally think that there's any serious chance of that ever actually happening and be ratified legally. I don't believe that that would essentially end any and all investments in Germany. No one would, if the government can just come on in and take, then I don't think I don't think that would ever happen. But of course, the price is reflects the risk as always. And if I was to extend that into most other European REITs, then you would have there's a lot of companies in England, and with all the Brexit, still we don't know where all this Brexit stuff is going to land. So their valuations have been compressed, a lot of them, because no one knows what's going to happen with things are not going great. Let's say it like that in the UK at the moment. So
Yeah, and they
that is one of the reasons.
yeah, and in the UK they don't have immigrants anymore, like people from Poland
Exactly.
that would actually rent the places there. So they're a
Exactly.
bit screwed up there, I would say. Yeah, that's really interesting, right? Because Vonovia is really one of the darlings in the dividend investment community from the
Yeah.
European dividend investor and you can see it also in the pricing, right? It was going down lately as well during due to the political risk, but that's also one of the reasons why I like Castellum actually much more. It's a different kind of a real estate company, but I have a feeling that they're more by being in Scandinavian countries, specifically Sweden. It feels all a bit more stable, and the German risk here is really present. And the politics are really intensive at the moment. Election time,
Yeah.
on the left nothing is right, and on the right is usually nothing left right.
Exactly.
So, So that, I think that sums up Vonovia pretty much here. But I believe you're also you also know about some other European rights, right? Right, and I believe before the show you mentioned one from Belgium also to me.
Yeah, I think it was Rafa who asked if there was any European REITs that I would kind of recommend having a look at. And of course, I think that Vonovia is dirt cheap at the moment. I think that you might be well served by having a little of that. But I found a Belgian company called Warehouses de Pauw. The ticker is WDP, which is listed in Belgium, and they do logistic properties in Belgium, Holland, Luxembourg. They have a lot in the Eastern Europe, primarily in Romania. So they are very well situated for the whole. What we have a lot of in the US is these logistic REITs that are. We have a lot of shopping online and groceries being delivered and Amazon.
Distribution centers and
Exactly.
warehouses. Yeah.
And this is still in relatively new and I'd say relatively new. I know it didn't start yesterday, but it's not being built out to the same degree in Europe. And I think it's coming. There's a lot of surprisingly enough, a lot of German companies like Delivery Hero and stuff like that are doing a lot of stuff. So I think that's going to be a sector that's going to be very interesting to follow in Europe as well. Some of the big American companies have been on fire for the last couple of years. So I think it might be a good time to get into logistic distribution centers here in Europe as well.
Yeah, and there seems to also be a market consolidation at the moment
Exactly.
between some of those delivery companies. Yeah, nice one. Never heard of it. Usually, when I hear about Belgium or Dutch real estate companies, those are commercial real estate, shopping malls, and such, like Euro commercial properties. I tend to stay away from it. Their dividends are really juicy, but they're just not predictable.
Exactly.
Here. And then, we also got quite some questions around the Real Estate Investment Trust Innovative Industrial Properties, IIPR. Is this the one around the cannabis and the weed?
Exactly.
Oh, nice. So
The Dutch company.
the Snoop Dogg Investment Trust.
Yeah. Yeah. Well, I think the thing that most people misunderstand about this is that people think it's just a place where you grow weed, right? And that's not it at all. The thing
You can do that in every house, right?
exactly
Yeah.
that's just a greenhouse. You don't
Yeah.
need anything special for that. But the thing is that they don't produce marijuana for recreational use. They only
Mhm.
grow and handle marijuana for medicinal use, and that requires some some uh, some standards. It's essentially the same kind of production facility standards that you would have if you were producing cancer drugs or whatever type of
Mhm. Yeah.
medicinal product. And that's the whole ball game right there for them. That's the big thing, because if it was just having a greenhouse, then everyone with a big field could essentially just construct a greenhouse and be in business. But that's not it at all. It's very specific requirements, very expensive requirements that you have to comply
Yeah.
with. And so that is why they have some competition, but it's not a lot. So we can talk about moat, and then is there a moat? Yeah, there is, because it's going to be expensive to, but it's not impossible. I mean, if you have the capital, you can build
Mhm.
these facilities, but
Yeah.
it's not that simple. So
Yeah.
that is essentially the the whole thing that keeps innovative industrial properties relevant is the fact that they are the ones that they were the first movers here, so they have the production facilities for all these companies that need to buy medicinal or have it handled in a specific way. So that's why they are interesting. They're
Yeah,
expensive, in my opinion,
yeah.
and but yeah,
That's probably the main thing that Wolf of Harcourt Street and Dividend Wave and Rafa wanted to hear. Is it expensive or not?
yeah. I think it's become a darling on yeah, because it's been on fire.
Yeah,
There are a few others that will become very interesting in that area that are smaller, and
yeah,
they are actually on the exchange, but not yet dividend paying. You still need
yeah,
to make money before you can pay a dividend, even as
yeah,
a
exactly.
investment trust. So
Yeah, a good one. So, and then there was also a question from Centrino about Omega Healthcare investors, and maybe I can talk a little bit about that because I've got it for 5 years in my portfolio now, and it dropped till 30 euro. It even went a little bit below 30 euro into 29s, and the question is typically, or is now the time to buy? So I actually did a video about it not too long ago about real estate investment or high yielding companies, let's say. And I find Omega Healthcare starting to trade at its fair value right now. So my fair value is around the 29 something. So it's not cheap. It's just the fair price. And then if you look at the market we are in, I mean, if you want to create an entry position, maybe now's the time. But it wouldn't be for me a position right now to start building up really rapidly. Why is the stock down? The COVID-19 impact is starting to really hit the company now, right? In the sense that they have almost 9% of non-paid
yeah,
I said contracts at the moment, which is actually not an issue because if you follow the company, they're extremely transparent about what's happening. The political risk is with Omega Healthcare is continuously on there, and that's why it pays an 8% dividend or something like that, 7%, because of the political risk. Because with Medicare, Medicaid, Trump wanted to kill it. He failed with killing Obamacare. Biden will keep it, but he is also looking again at certain elements because generally healthcare in America is too expensive, and Omega Healthcare benefits a lot from being expensive because what they effectively do is if a person has only a few weeks left to live, you go to Omega Healthcare. They take half of your inheritance in fees for keep maintaining your bed. You'll die quite quickly, so they have a high turnover as well. It's a perfect business model because people typically or families are in a weak position right then. They will pay up to for these kinds of things.
yeah,
That's what their business model is. Politicians don't like it. They think this stuff is too expensive. Omega Healthcare is not the one charging them, but the renters are charging this. They provide excellent properties, good locations, and I've accepted this risk. I got a high yield in return for it for over the last 4 or 5 years, and it's one of my best dividend payers in my portfolio. So this long term, I think it's a pretty good deal. Short term, there are definitely some risks here that you need to
yeah,
feel comfortable with. A dividend cut could happen. It might go from 7% to 5%, but this is not something that goes to zero overnight unless there is fraud. Yeah.
yeah. I agree. I completely agree. If you want to build a long term position, you're not in a hurry, in my opinion. You can wait there because, like you said, there are some risks, but it won't go to zero. Let's just put it like that.
Yeah,
So
yeah. Okay, so before we close out this topic then about real estate investment trust, and because we still have quite some questions as well, just out of curiosity, which real estate investment trust are you really bullish on right now? Would you like to share that with the audience?
actually, I quite like a company that was in your portfolio review the other day, last time. I like the company called Vici. quite a lot. Vici is a it's essentially kind of the same business model as people will know from realty income. It's called a triple net lease, which means that you own a building, you find someone that will lease the building, they will pay you to lease it, but they will also pay the costs of maintaining the building and taxes, insurance, and whatever. So you essentially hand them the keys and they will pay you for that and they will pay everything else. So that is the difference between them and realty income is their customers. The customers are the ones that runs the casinos, all of them basically in Las Vegas. They own most of Las Vegas, all the big, the really big casinos on the Las Vegas Strip, including the second largest casino property or hotel in the world. So, and it's been trading sideways for essentially the last 6 months. And it has, of course, to do with the fact that there are no tourists in Las Vegas. So, because you can't travel to the United States at the moment, if from Europe, you can't from Asia. So it's although Las Vegas opened, it's only Americans, and and there's whole issues still with the COVID-19 and whatnot. So, but I think that long term, that is very much a property company that I would love to own. I really like the company. Uh,
Super.
I'm very bullish on them.
Well, and we know that sex, drugs, and gambling will always be popular, and always
Exactly.
people want to pay up for it. So from
Yeah.
that point of view,
The
Las
city of
Vegas.
sin will never die, I think.
Exactly, exactly. And this is maybe also good that you mentioned that because we reviewed the portfolio from Mark van Essen last week, and
Yeah.
EMF and I were, of course, talking a little bit like maybe you should reconsider some of that. And then you reached out to us on Twitter, so hey guys, you actually have it quite a bit wrong. Mark has, you know,
Yeah.
he has actually quite an interesting portfolio. So you challenged us a little bit, and I think it's really good that you give that voice. And I believe you also had some other thoughts about how you say it, about Star, ticker Star, SDAR, and such.
Yeah.
So maybe you could give your voice as well to put it a
Yeah.
bit in balance to what EMF and I said.
Yeah. So the Star ticker, the company called iStar, they they have appreciated quite a lot, about 125% the past year, and then automatically it looks as if it must be overvalued. But the thing is what Star actually owns, and they own another. Well, they own 2/3 of another company that's called Safe. It's called Safe Hold. The ticker is Safe, um, and and they have a very revolutionary new concept that has been very popular with the real estate community. So that's so in the US. So this company has skyrocketed, and so Safe is currently worth 4.2 billion US dollars. And remember, iStar owns 2/3 of that equity. So that's around 2.8 billion that their part of Safe is worth. And iStar is only has a market cap of around 1.8 billion. So they own something worth 2.8 billion, but the company itself is only valued at 1.8. So there is a massive disconnect there.
Yeah.
They should be trading much higher. And so I think that at some point the market is going to realize that, and that then Star will be valued at a more reasonable price. I think it could easily double from here. So I
Thanks.
think
Thanks.
that Mark has, depending on when he got it, I think Mark is he's got a he's got a pretty good thing going here. if he bought it a year ago, he should be happy. But if you look
Of
at of course, if you look at the dividend currently, then it's not great, but it
mhm,
all depends on where you got it. So
yeah.
yeah, so
Well, thanks for that, Mark. If you're listening, I believe you heard it now from Mr. Reed himself. I think better listen to him than to us. And I hope this helps you also still in your evaluation for your portfolio. But having said that, we actually have the next person also with their portfolio here. And let's have a look into that because it's actually quite popular. People reach out to us to review their portfolios. In this case, it's Casper Heung. I'm not sure if I pronounce it well. Casper, let us know. If not, and he has a quite interesting portfolio that he shared with us. And I will go a little bit through the tickers. The first ticker is DEC. It's an energy company from the UK. The second, and by the way, he has a position of almost 25% of his whole portfolio in this. We'll explain a little bit more there because he put a narrative around it. His second position is Johnson and Johnson with 8.4%, then Realty Income with 8.1%, then Stag, the industrial real estate company, with 7.1%, and Unilever with 6.9%. Now, you might first think like, okay, DEC with 25% almost, that's a hell of a lot of a position, but he has been quite clear about that. He bought it on the dip in 2020, and we all know that it grew almost like 60, 70%. Great dividends on top of that. And yeah, it was really just a value play for him, effectively. And I think he's happy with his position. And based on also the gas prices going up, it really serves as a hedge for his portfolio. So that's how he looks at it. And yeah, I wanted to ask, what are your thoughts when you see this portfolio?
yeah, without the context, I would have been worried about the size of his top position there. But he explained it quite well. Actually, he got in at a very great at a great time. They pay a sweet dividend. That he also says he uses the dividend to enlarge other positions. So normally, if I would say that probably having a quarter of your portfolio in one position, it might be a little much. Um, but if I was him, I'd probably at this point, like we already discussed, gas prices going through the roof. A gas company. I mean, it's hard to imagine that it won't be a great investment for him. I would hang on to that and then, like I said, use the dividends. I
Yeah,
like the rest of his portfolio, Unilever and Johnson and Johnson. I mean, two top quality companies. Realty Income is a great company, and then he's got Stack, who is this industrial logistics company, a little specialized. They do one tenant kind of solutions,
yeah.
which is so it's like a niche in I'm but it's very popular because of the way they pay the dividends.
The
So
monthly one. Yeah,
exactly.
yeah,
So to me, it looks like he has a there's a liquidity thing going here for him. He's got two monthly payers, and then he's got the gas company, and then the two stable
yeah, yeah,
companies.
exactly. So,
So
and if I'm correct, this energy company is almost paying 10% dividend, right? Still today after
yeah,
the run up. So this is just
so,
like massive, massive dependency. So this is also, while I like his portfolio as such, because he also shared the rest of the portfolio where he has some healthcare companies in there like Apfi and Bristol Myers, also Relax, which is together with Wolters Kluwer, really the two market leaders in the information services industry. He has Rio Tinto in there, Ahold Delhaize. So he has a really nice diversified portfolio with really good trustworthy dividend payers, let's say.
exactly.
So the only thing I would suggest now is like if you're still in the early days of accumulation, start to lower the exposure to DEC. And so it's a diversified energy company.
Yeah,
Lower it not by selling, but just by not buying more and redistribute the dividends to buy more of the rest. And over time, it will be probably come like the rest, like 4 or 5%. That would
Exactly.
be my recommendation here. Other than that, it sounds quite good. Also knowing that the other companies in the portfolio are not trailing so much behind in the percentage of the portfolio from the others. So yeah. So Casper, I think you've got a really good portfolio. Price yourself lucky with diversified energy as your main holding. It was I mean, an excellent play, I would say, with all what's happening now. So well done. Okay, having said that, let's go to the final part of the show, the listeners' questions. We'll have to go a little bit quicker through it, Dividend Dane.
Yeah.
So let's get started. We have the first question actually from Mark van Essen, who we reviewed his portfolio last week, and he asks if we know anything about HRL, which he's looking into at the moment, and what do we think about the company and the stock? And then secondly, what do we think about the concern of inflation putting pressure on margins in this sector? Does it look like is it a temporary thing, or what's your take?
I think I believe it's Hormel. They do canned foods of all sorts. In I don't even know if they're in Europe, but I know they're in the States.
Mhm.
I think that food prices, like everything, has gone up. I don't
Mhm.
think that Hormel can evade inflation. That would surprise me.
Yeah.
Um,
Yeah, really simple. Look, Harmel, and I think that's also why he's asking it. It almost dropped 20% in the since August, let's say. So that's why it probably pops up on people's radars, but it still has a PE of 26, a dividend yield of 2.4 for a food packaging company, let's say, a consumer staple with minimum growth. I find that how you said. I find it just not attractive. It would need to, for me, it would need to probably trade around the low 30s to become interested in such a company. So Mark, I would just actually look maybe more in how is it with ticker symbol GIS. I forgot the name quickly of the company.
General Mills.
Yeah, General Mills. It's funny. I know the ticker better than the company name because they went also a bit into pet food. Maybe there's some more growth profile behind that company. Okay, so the next question is from Martijn Hoek. I know it's particular regarding to a tweet from me because I ask where do I put my war chest, because I put a tweet out that I still have a war chest, and he asked me, is it on the bank or in the S&P 500 ETF? A big crash only happens once in 8 years, and the ETF provides a historical 7% annual raise. So it's really simple. I have it on the bank, and it's stupid. I just need to start spending it in the stock market. I realize this, but it's still quite a significant amount, which I can't just get rid of it in a month. I mean, technically I could, but I won't. I don't want to. So I'm just investing a little bit more every month by pulling some money for it, but it will probably still take me a year. So at the same time, I'm just hoping for a market crash so that I can use it more. But I learned that having a war chest doesn't really matter that much. I'm losing out on the accumulation of dividends and the compounding effectively here, and then inflation is eating it up. So that's my learning. I want to get rid of it, and it's purely on the bank, because if I would put it in an ETF, I would risk losing it, and that's not why it's a war chest.
No.
Okay. So then the next question is from Depper Dividends, and he is asking, what do you say to those who claim investing in real estate investment trust are substantially inferior to outright investing in real estate?
Yeah, I've heard that before. There are several. To me, there are a lot of differences. Um, First of all, buying physical real estate is expensive. It requires a lot of capital. if you that you don't need to buy real estate investment trusts or other real estate companies. You can diversify with real estate investment trusts. You can tap into different secular growth segments, like you can buy some data centers, you can buy some logistic companies, or this wheat cultivating companies, or and all other sorts. You can diversify geographically. They're not. Then there are things like, once you own a property, do you know how to run it? Do you need to get someone to run it for you? Can you fix it yourself, or do you need to? I mean, you don't have to worry about. So there can be some good reasons to buy real estate, of course. Some might even be there might, depending on where you live and what type, there might even be some tax advantages and stuff. But I, for the unless you have a couple of €100,000 that you can just buy, so whatever, then I think it would be much smarter to have a little as an investment. It's another thing. It's where you live, but if it's an investment, you can buy a lot of stocks for the price of an apartment building. Let's just put it like that.
Yeah, super. So then the next question is actually also for you from Phil, and he's asking, how does Mr. Real Estate Investment Trust see REITs that use their property buildings for a service or product on their own? Should we see and evaluate them as a real estate investment trust or a traditional company? And he's referring, for instance, to Iron Mountain with the data management storage, or maybe Weyerhaeuser with Timberland. But I would even say add to it McDonald's. Yeah.
Yeah, yeah. That that's always McDonald's is always the where people are surprised when they look into
Yeah.
to their books. I would say like this, that like any other company, it doesn't really. You have to look at the basics of it. Like a company like Weyerhaeuser, for instance, they own a lot of land where people plant trees. Some of them they plant themselves, some they just lease out to others. But a lot of it's a very cyclical company. It's a commodity, so the price of timber goes up, it goes down, and depending on all sorts of things. So I would say it depends. Some you need to look at as a real estate investment trust. Some you could look at as a regular company. Now, a quick comment on Iron Mountain, because I'm not quite sure that people really know what it is that they do. They still have People think that it's a data storage uh, company, and that is what they are trying to become, but they are not there yet. Still, the data center part is still only 12% of their revenue, so it's a small part. They still have 73% of their revenue from storing of physical records. So that is essentially paper that they are trying to, it's a deed from here, or will, or public records of all sorts. People in Europe will, depending on where they're from, will know that a lot of countries in Europe are not still 100% digital.
Yeah.
So there are mountains of paper stored everywhere, and that is primarily done by Iron Mountain. So just a quick note on that. So people should know what they're buying. They're not buying a data storage center.
Super. Which leads us to the last question, actually, for today. And the question is from Gonzalo Josepinto. And he asks us about our thoughts of Altria and British American Tobacco. I can actually answer this one.
Yeah.
Look, why are the prices so down this week? Is because Reynolds won a patent case which I think puts Altria in a difficult situation because I believe they have to stop the sales of their IQS tobacco heating product. And this is really and specifically Ultra. I mean, they're really screwed, right? They invested, what was it, 9 billion in Jules?
Yeah,
That was like a dead cat in a box, like Schrodinger's cat.
exactly.
Now IQOS, they're really screwed, right?
Yeah,
And it also, of course, puts an issue on British American tobacco because when there's a patent kind of thing hitting the industry, it scares the hell out of everyone. At the same time, I believe British American Tobacco also has some claims lying at Philip Morris and such, Altria. So it's really a patent war going on at the moment with all the
yeah,
new combustible or non-combustible cigarettes. Honestly, I think either they will settle it quite quickly or not, right? In that case, I see more trouble for Altria being in the United States than for British American Tobacco being British, let's say. So it's just, again, it's a risk now. Now that you have this information, you can do something with it. Does the yield justify the risk or not? Again, the company will not go bankrupt anytime soon. It might compress the earnings going forward a bit or the cash flow. But come on, if you look at British American Tobacco as an example and the cash flow that they have, I'm totally not concerned about them as an example. So those are my thoughts about the two of them. And it's very interesting to see what's happening. And I know I met some folks from Philip Morris the other day at a conference. And you know that we can't, that they don't like it anymore if we tell them that they're from the smoky company. They don't like it because what they say is we produce inhaling products
yeah.
because they are trying to rebrand them also more into the medical care or the pharma space. Really interesting how they think about it. I also believe, and you see it in the strategies, they're really going for it. I think also they have an asset there, but they still have some reputation to do, I think, because they're still selling these inhaling products, let's say, that
Yes,
are quite addictive.
exactly. I think if I was part of a tobacco company and I wanted to make inhaling products that were medicinal, I think I would spin that off into another company.
Yeah,
Just
probably as
the
well. Yeah,
whole branding thing
yeah,
is going to be very, very difficult, I would imagine.
exactly. I
And I
would
don't
call
know
it.
anything about the technology or
Yeah,
anything, but and if they can do something medicinal,
yeah,
why not? But I think
super.
the image part is going to be an issue for them.
Yeah, good. Hey, it brings us to the end of the show, Mr. Reed. No stock picks this week. I mean, my stock pick is Alibaba. There are some others more interesting, like Allianz and such. Alibaba is down again today. It's now $143. So I'm looking again on buying few more shares. Maybe next week. Let's see where it goes. But I really would love to thank you for today. I mean, EMF and I don't talk so much about real investment trust because it's not necessarily our circle of competence. Of course, we know few of the more popular ones, but your knowledge is really second to none compared to us. So, thanks so much for joining again.
It was my pleasure. Always fun.
Super. Hey, if you stayed so long with us in the podcast, thank you so much. It's really great having you guys. And yeah, enjoy the weekend and see you next week again.